Guys, you've heard me say this 1,000 times. Yield farming is the best way to generate passive income for the common man in the history of mankind, and it's not even close, because for the first time in history, we're allowed to be market makers with our own assets on decentralized exchanges, just like regular market makers are allowed to do on centralized exchanges in traditional finance. But how do you know which tokens to yield farm? That's exactly what this video is going to be about. I'm going to give you the 4 things I look at before I provide liquidity in any token or tokens. And if you stick around to the end, I'm going to give you a 5th one that's a bonus. That's kind of like a hack. So before we get started, I do have to say this video should not be taken as financial advice. Consult with your financial advisor before making any investment decisions. This video is for your education purposes only. So without further ado, let's get into the content. So guys, let's start off with what yield farming even is. So yield farming is the act of staking your liquidity on different decentralized platforms to facilitate whatever their operations is in exchange for you getting a yield. Now, it's 3 main ways to get a yield in yield farming. Well, you can technically say 4. One is staking, and this is the least profitable one. This is where you stake a token. Like, for example, let's say you have some Ethereum and you want to stake it on Lido to get a 13% yield or whatever it is. You can do that, and you're essentially staking your coins to help secure the network. The second way is facilitating insurance premiums. So you can go to a site like Nexus Mutual, stake your tokens, and they use your liquidity to pay out insurance premium. Third way is borrowing and lending. So you have platforms like Aave and Compound and Maker where they have suppliers and borrowers. You can supply your liquidity on there and they loan it out to the borrowers, and they charge the borrowers an interest rate, and that's how you get paid. And my favorite / most profitable way to yield farm is to stake your tokens on decentralized exchanges such as Uniswap, Trader Joe, PancakeSwap, QuickSwap. You know, you've heard of all the decentralized exchanges. You deposit your tokens into pools, and whenever people trade inside of those pools going to and from whatever the assets are, you get paid whatever your proportion is in the pool. So if you have $10,000 in the ETH USDC pool, you have 5K in ETH, 5K in USDC, and it's 100K in the pool, since your 10K makes up 10%, you get 10% of all of those trading fees, okay? So in this video, we're gonna be talking about the 4 things I think about when providing liquidity on decentralized exchanges. Okay, so the first thing I think about is that I have to be okay holding both of these assets. And that goes for stable coins and volatile assets. Doesn't matter what the pool is. If I have 2 stable coins in a pool or 1 stable coin, I normally don't do double stable pools because the yield is extremely low because everyone's in them. And you don't really have to worry about impermanent loss. So it's just an easy thing for everyone to do. But I have to trust the stable coin. I normally don't provide liquidity unless it's DAI, and sometimes I won't even touch DAI, but mainly USDT, Tether, and USDC. And if there are 1 or 2 volatile tokens, I have to be okay holding that volatile token. So like, for example, if I'm in an ETH USDC pool, I have to be okay with only holding ETH. And the reason why is because there's something called impermanent loss, which I'm going to explain here in a bit. In order to be bullish on a volatile asset, that means I have to conduct proper fundamental analysis. And that includes looking at the team, the problem they're solving, the tokenomics, pretty much all the research you guys see us do here on this channel and on the Know It Owls channel. By the way, if you got value from any of these channels, please subscribe, drop a comment, etc., etc. If I'm not conducting fundamental analysis and I'm not bullish on this project long term, it's gonna make me want to think short term and exit the pool as soon as I experience a little bit of impermanent loss, or if the token price drops when, you know, it could be a buying opportunity. All right, guys, let me explain to you exactly what impermanent loss is. So let's say I get into this ETH USDC pool, and you see I have these 2 green lines. So let's say I want to provide liquidity within that range, which is 2,078 and 2,745 for the price of ETH. So whenever ETH is in between this range and people are trading back and forth in this pool, I'm making passive income in proportion to how much my liquidity makes up in the pool, like I said. Impermanent loss happens when, let's say I start going down, right? Let's say I hit my green line or I go below it. Well, the smart contract is essentially going to limit order by the loser. And sometimes impermanent loss can be your friend. I've talked about this in other videos. Impermanent loss isn't all bad. It depends on your strategy, and you want to have a plan before you go in. But if I go down out of range to the downside, I'm going to be in 100% ETH, which could suck because now I'm in 100% of whatever the losing asset is. And the price I pay in impermanent loss when it goes to the upside is foregone opportunities. So if it goes up, I'm going to be in 100% USDC. So this can really bite you in the butt if you're providing liquidity for some assets you don't believe in, and let's say they drop. Well, you're going to be 100% in an asset that just dropped 90%, 50%, 60%, or whatever the case is. So you want to make sure that if something drops 60%, you're excited because you just got it at a discount. You can buy more, not regretting it just because you hopped into a pool because the yields were high. The second thing I look at before I provide liquidity in any pool is to make sure that there's enough liquidity, and then to make sure that there's a favorable volume to TVL ratio. Okay, and what I mean by liquidity is essentially TVL. You don't want to look at a pool that has an APY of 1,000%, but the liquidity is only 100,000. There's probably a reason why the liquidity is that high. People probably aren't trading it that much. And if the liquidity is only 100K, it doesn't have to be that much trading for you to make a lot of fees just because it's not a lot of liquidity. To give you an example, let me show you guys what I mean. All right, so let's say I'm on Uniswap and you scroll down and you just click top pools. You see it pretty much shows you the top pools on whatever that chain is. So right here, the top pool is wrap Bitcoin and ETH because it's the highest TVL. Now, when they say top pools, they don't go off the volume to TVL ratio. They're looking at just the TVL. But let me show you an example of what a good volume to TVL ratio is. So the second pool right here, USDC ETH. And if you look here, you can see that in 7 days, it did $1.09 billion in volume. The past 24 hours, it did $285 million in volume, but the TVL is $172 million. Now, $172 million is a lot, but the volume was higher than the TVL versus a pool like this where the TVL is 91 million, but the volume was only 7 million. It's significantly lower than the entire TVL. And the higher the volume is, that means the higher the passive income is for the liquidity providers who are providing liquidity in that pool. The third thing I look at before I'm providing liquidity in any pool is to see if I can maybe allocate funds into one of the concentrated liquidity managers that I cover in this channel, or find a decentralized exchange where I can get into that pool where the asset that I wanted to provide liquidity in, and see if there are rewards I can get. Perfect example of this is I talked about in my Gamma Strategies video. Definitely feel free to give that a watch. By the way, I did make that video before they got hacked. They did get hacked, and it was a significant decrease in TVL, so keep that in mind. But they had a wrapped ETH OP pool where they paid you in OP rewards if you got in the pool. Now, I ran a position alongside of it where I was just in wrapped ETH OP and I was managing it with, not a super tight range, but a semi-tight range. But the Gamma Strategies vault was outperforming mine, even though they had fees, just because the rewards were so high. So if you can get rewards and now you have to do less work and you can make more money, that's always a good thing to be able to do. And since I'm touching on that, there are sometimes opportunities where you can farm and dump. A lot of times protocols to bootstrap liquidity, they will reserve a portion of their tokens to pay out to people to provide liquidity. And a lot of times people will just go and provide liquidity. They'll take the tokens and farm them, and then dump them right after. That's not a bad strategy, especially if you're, able to claim your rewards and do it like automatically, because a lot of times these farm and dump tokens will usually nosedive. So you want to make sure you're selling and not accumulating them so that the value can just drop. Now, this is, like I said, this isn't a bad thing, but me personally, I do prefer to provide liquidity and earn rewards in a token or tokens that I am bullish on. But like I said, farm and dump opportunities do present themselves sometimes, and they can be good because the yields can be high, and if you can just sell that for USDC automatically, that's not bad. The fourth thing that I look at, and after this I'm going to give you the bonus one as promised. The fourth thing that I look at is being able to analyze market trends to be able to come up with some kind of prediction as to where I think the market's going to go. So that way I can develop my plan for the ranges I want to provide liquidity in for this pair, as well as for how long do I think I want to be in this pool. Just like when you're buying and selling assets, you want to have a plan of getting out before you actually get in. It's the same exact thing when it comes to yield farming. You want to have some idea as to, okay, I want to be in this pool this long, I want to get out when this happens, when this price is reached, when this level is reached, etc., etc. And being able to conduct a plan involves you, like I said in the beginning of the video, conducting proper fundamental analysis. So you know what's happening with that project. Maybe you know when a token unlock is happening, where a lot of those tokens are going to be flooded into the supply. That may be a time for you to exit the pool. It may be a time for you to short that asset, or they could be expanding to another chain. They could be launching some other killer product that could bring on more users that can make the price go up. They could be announcing a partnership. These are things that you want to be looking at because it's going to involve your strategy. It's not just getting into the pool. You also have to manage your pools as well. And along with that, you have to be able to know how to conduct proper technical analysis so you can look at major liquidity levels, support and resistance levels to see, when the bulls are coming in, when the bears are coming in, when they're strong, when they're weak. Like, all these things are extremely, extremely important when it comes to coming up with your plan. And you need to go through all of these before you enter a pool. Do not just look at a pool and look at some high yields and ape in, all right? If you guys want to know what not to do, I made a video on the top 6 mistakes that yield farmers make. Definitely give this a watch. If you just don't do these things, your likelihood to succeed as a yield farmer goes up exponentially, I promise you. Okay, and now for the bonus. As promised. The bonus thing that I like to look at, and this isn't every single time, but sometimes these opportunities present themselves, doing fundamental analysis on a token and coming up with the reason as to why you think it's gonna have a lot of buying volume, and then getting ahead of that volume. A good example of this is Shiba Inu. If you were looking at the block explorer, you saw a lot of people were buying Shiba. If you were providing liquidity for Shiba ETH pair, and depending on your ranges, you could have been playing with house money after only 2 to 3 months. You know what I like to compare this to? The people who were selling shovels in the gold rush. Shoot, you never know. If you really think about it, shoot, some of them people probably got paid in gold just for providing those shovels, just like you get paid in the asset you're providing liquidity for in a yield farming pool. If you want to learn this skill like a professional, head over to KnowItAll.xyz and click the Get Started button. We have a Know It All Academy that covers everything you need to know regarding yield farming. These are some of the courses here. And we also have a traditional finance course that covers these things here. We have a world-class team, that's me right there. And these are our team members, our coaches who you'll be working with. We have a comprehensive course, like I said, that goes through everything regarding mindset, chart mastery, so you can conduct proper technical analysis and master your entries and your exits. Fundamental analysis, so you can have strong conviction on what you're buying and holding, and just how like Web3 and crypto fits into the whole traditional financial scheme. Security protocol, so you never get hacked. Intro to yield farming and advanced yield farming that covers literally everything you need to know to develop a strategy for yourself that aligns with your personality and risk management and risk appetite. And after you go through the course, you'll get to talk to me and the coaches via live calls, get access to the recordings if you can't make it. And we're just a group of people, a mastermind who are passionate about crypto and love sharing information and bringing different opportunities to the group so that we can all benefit and all have each other's best interests. So if that sounds like it's interesting to you, like I said, either go to the website or you can just click the link and book a free strategy session and talk to someone with our team. And ultimately, we'll see if it's a good fit for you. But guys, with that, I'd like to conclude this video. Like I said, if you got value, consider subscribing, drop a like. I'm trying to hit 2,000. I just hit 1,000 after building this channel for a year. Let's see if I can hit 2,000 in half of that time. I thank you guys for tuning in. I love every single one of you watching, and I'll see you in the next video. Take care. Huh.